Speaking to you here. Thank you, Peter and Rita. Yeah, I'm speaking to you from Worthing. It's a nice little coastal town, the south coast of England. If you hear seagulls squawking, it's because we're not too far from the beach. And the sun's trying to come out despite all the rain and everything we've had in England. But there you are. Now, okay, so welcome to the gentleman who's only had it for one day. Solomon. So welcome. So if you may be a bit confusing when you first arrive, because you've got to really forget almost everything else you've learned in the past. Because if you're experiencing a hard time trading the market, that's the reason, is that it's hard at the best of times because the market is not there to help you. Nobody out there is saying, right, we're going to help these poor guys who are trying to make money out of us. No way. And so you keep that in mind. And believe me, they will send out rumors, lies, all sorts of things to better their own trading. And you've got to remember that the market has to have more losers than winners for it to work. You cannot trade these ups and down moves like this if everybody was winning. It just wouldn't work out, I'm afraid. Now we have a piece of software here that has automatic signals that without any intervention of any human being whatsoever, and many of the signals were written 10 years ago or even 12 years ago, and they're still valid, they're still working, and they will be working in the next 20 years, 30 years, and then we don't call them buy and sell signals. What they are signs of strength or weakness entering the market. But you soon get your head around that. Right now, we've got a chart here showing you a 15-minute chart of the mini S&P 500. And you can see it's been going up, but let's look and see what's happened today. Now, right on the low here, is there a sign of strength there?
Yeah, next one.
That's it.
Yeah, potential selling climax.
Yeah, potential selling. That's. Please read these dialog boxes. That's it. Please read these dialog boxes and relate them to the chart, and then gradually you'll get your head around all this, and you'll see what we see, because I would tell you there are no such thing as secrets in the stock market. If you get websites or people out there saying that we'll reveal secrets to you that nobody else knows, or only the pit traders know, believe me, you're being groomed for a con. And especially when they say you've got to pay us so much money to attend the seminar to get all the secrets. You are being groomed for a con. And what we can do here, we can prove to you that what we tell you, we say there are no secrets in the stock market. It's all written in a chart here. And if you consider these signals fairly accurate or whatever, look, there's one right at the top here. Okay, we'll press the
Potential buying climax.
Potential buy. Read the dialog box, and it tells you why that signal's appeared. Now, if you think these signals are reasonably good, then what it means is that the information that we fed into the program via a programmer must be reasonably accurate. It must be the truth. Otherwise, it just wouldn't work. You tried, if you're good at programming, you program something in to try to detect the stock market. If you haven't got it dead right, nothing will happen. Now, even that signal there, we've got the signal here, look. Right there, look.
Saying supply coming in.
It says supply coming in, okay. And yet you say the professional money Now, when we use the term professional money, we're talking about the dealers that can throw 5,000-6,000 contracts at this at a time, and they follow each other and copy each other, a lot of them, will alter the balance of supply and demand sufficiently to change the trend. Okay, now, admittedly, this is Globex here, so it's not all that clear, but anyway, it goes sideways, look, and there's a test, look, and you'll find all about tests, right? That black bar, you'll, we describe tests frequently, but the professionals know that's there, that weakness. So they say, right, we'll get them. So we'll mark it up. Look, mark it up. We watch this, Gavin and I, watch the signal come in.
Potential buying climax.
Yeah, that's another sign of weakness, obviously. Weakness, when it appears, will appear on an up bar because the size of their holdings are so great that they have to unload on good news or as the market's been marked up. And you think that's quite logical. And then the next bar's down. We call this a top reversal, right? And that is a 2-bar, what we call a 2-bar up thrust. And it's there because the weakness came in here. So remember, the market is devious, it's cunning, it's out to get you. So you may look at that signal and say, oh, yeah, it's not, doesn't look all that good right to me. And they know that. And bang, up, catch stops. Remember, there are hundreds of thousands of stops above these markets. Encourages traders to go long. Panics traders are shorted, prematurely shorted, and so on and so on. And then the next bar's down. That's a 2-bar up thrust. And if you ever see that and you've got weakness in the background, you know you're facing a weak market. And then these wide spreads down, look, close near the low immediately after a sign of weakness. Don't think that just happens. That's done deliberately because they want to lock as many traders in or out of that market as possible. If you're up here, you might be clever enough to think, oh, I think I'll short this. And then you wait, you know, you ponder, you wait, and then bang. And then they know how the herd thinks. The herd thinks, oh, well, I missed that now. Too bad. I should have shorted that. And so it goes on. And also, if you happen to be long, you panic, and they know eventually you'll be shaken out if you've got a long position. That's how it works. Now here we have a down bar, close on the high. There's an increase in volume, and that looks like some support that's come in. There's even a signal on it, right? However, there's a rule here that if the next bar is up on no demand, you should either ignore the signal or be very, very careful about taking any long position. So we move to the next bar, where there it is, sorry, and then we look at that volume, look, and there it is, pink. The computer has colored it pink for us. And that means that the volume is, relatively speaking, don't forget we use relative volume, right? And that's why VSA gets away with a lot of skullduggery, because it doesn't go on mathematical formulas, it doesn't go on precise volume measurements. That's why we don't have to have an open or anything like that, because people that use formulas need the open, we don't. But that, look, is no demand after these high volume bars, and the computer on that bar, that is weakness. That is what we call no demand after a sign of strength. There's probably some buying came in here, volume surged up, look, okay, closed near the high, but don't forget, professional money can make mistakes too, and they do. Excuse me. Anyway, next bar, look, up, no demand. There's no signal on that one. But don't forget, this program works on any time frame. You can use a 1 minute, 2 minute, 3 minute, 9 minutes, 16 minutes, any time frame. And all these signals will appear. Some charts, they look better, some look not quite so good. But they're all there, basically. And that works without any question. If you think too much about it, you think, well, that's impossible. How can that happen? How can you get signals on every time frame when the data's hopping around all over the place? But the only way I could describe it is, imagine you are a doctor in a hospital and you go up to your patient and you diagnose he's got pneumonia, say, and he's pretty sick. Okay. Now, it doesn't matter how many times you check on that patient, right? That patient's not going to get better until you see a turning point appear, which you as a doctor will recognize. And the same thing, and that's why these charts work on any time frame. Okay, but you'll soon get, remember, the chart is a language. It's a language talking to you. It's like Braille. And once you learn it or get your head around it, you'll have that skill and information with you for the rest of your life. And I can assure you, you will never, ever regret it. I mean, Gavin, this week, he's always taking $200, $300, $400, $500 out of the market. I'm trying to train him to stay in longer, but he's that type of guy. But even so, he is a good trader. And he's not, if he's wrong, he's not frightened to close the trade out and get the hell out of the trouble. That's the main thing with trading, is if you get it wrong, you must close your position out straight away. So, as they say, live to fight another day. So we've got no demand there, look. Clearly no demand, but there's not a lot of selling pressure in the market. Look, low volume and down bar. Professional money can see this. Now, we've got a down bar, look, narrow spread. Don't forget, it's called volume spread analysis. And the reason is we look at the volume, right, which is just above the average line, look. But on that average volume, don't forget volume is activity. It's just another word for activity. So there is an increase in activity there. And on that increase, the spread has narrowed. Look, anybody can see that spread has narrowed. Excuse me. And the only thing can cause that is that something put a floor across the lower price. And what happens is when the market dips like that, there's no selling pressure. Professional money is not interested on the downside of the market. Sorry, it's updating you. Okay, so that's what produced that signal. Look, automatic signal.
Potential selling climax.
Yeah, well, don't forget, dealing with a potential, it says potential selling climax. I would describe it slightly different, even though I wrote all those words. But don't forget, there's variation in the data. I mean, for selling climax, I expect to see volume up here somewhere. But it's still a sign of strength. Right, so next bar, up. And then apparently, was there news there, Rita?
255, yeah.
Right, so we got
bar,
the news, and they marked it up, look. Now, that's the opening of the S&P pit, so you will get what looks like very high volume because it's compared to the Globex volume along here. But no matter what language you talk, that's high. Right? The market rallies up close to the top. And because the volume's so high, the program's put a red arrow there. Right? Supply coming in.
Yeah.
Now, there will be supply in there, but there's also buying, isn't there, look? I mean, you've got to be practical. A widespread up like that. Now, what we did a seminar at Heathrow Airport, what, a couple of weeks ago, was it?
Almost, yeah.
And somebody says, what's my favorite sign of strength? And I've said, look, whenever you see a red arrow in a market moving up and the next bar is tested, and lo and behold, that's a test. That's a test in anybody's language. The volume is still fairly high though. But look, it's a down bar. Well, it's colored black because it's level, but it was down. It's the 15-minute chart. If you look at the 5-minute, you'll see that bar's down. It probed down, and the professional money were not at least interested in the downside of that market. So they must be bullish. And that is a very, very clear test. And what they're doing, they're testing this apparent weakness here. They can see that weakness there. They're not looking at the signals that come up, obviously, but they can see it in the market. There's some supply there. So they test it, and there it is, a test. That's a clear test in anybody's language, and that allows the market to start going up. A little bit of supply there, but look, another down bar. Narrow spread, closed near the low, but look at that low volume. There's absolutely no selling pressure in the market at that moment. None whatsoever, look, and that will allow prices to drift up. But this will be no demand. Well, no, it's not no demand. That's because it's looking at relative volume, right? It probably got slightly confused here, but there's a little bit of supply there. And the reason why it's done actually, it's gone up close near the low, and there is a slight increase in volume, look. Right? So actually, in fact, that's correct. What's it saying, Pete?
Weakness has appeared.
Weakness has appeared. Read those dialog boxes. The reason I say that, I've heard rumors that people don't look at them. Okay, so anyway, so we look at next bar. Right, it's not no demand, look. The volume's just slightly higher, very, very slightly. But they test, look. The volume is not exactly high, but there's a little bit of supply there, look. Right, that's why it's struggling to go up. Now this has been no demand, look. Look, pink, the color, the volumes, the computers color the volume or activity, pink. Right, telling you that that's low volume relative to the previous volume. So what's good about that is that they do try to fool you very often with volume. Like we know the London market, they can hold volume back for 36 hours or put it on the next bar and all this type of thing because they know they're not there to help you. They know that the top or lots of good traders understand volume. And that's what they're doing, and you have to pay for that data, which is almost unbelievable, really. But so that's, as far as we're concerned, there's no demand here, and that's no demand is making this market float sideways. Look, and we've even got sign of weakness here. Excuse me. Right, we've got an up bar. What's that say?
No demand.
Yeah, that's right. Look, no demand. Read the dialog boxes, please. There's lots of information there. Everything we know about no demand should be in there. We mention it so often. And that no demand looks sufficient to knock this market sideways. Now, there is a test there, look. And there's no supply. And that's why it's going sideways like that. That's why it's drifting sideways. There's no supply and there's no demand. And you've got some supply in the background. So it's just drifting sideways at the moment. And it seems to be arching over, which is normally a sign of weakness. Don't forget, it's Friday today. you've got to be very, very careful, because they will do their utmost on a Friday to fool you. They want to mislead you. The main reason is they want the media, who know more about the market than the media does, right, to come out with all sorts of stories. And they know they'll be looking at the chart and they've got no idea what volume is or what's going on. They're just really clever writers who are writing really a lot of nonsense most of the time. So you have to be very, very cagey. I always say, believe your charts, and don't listen to the news at all. Peter, could you show the daily chart for a moment?
Can I just answer a couple of questions that have come in?
Yeah, go on then. Yes. Yeah. Now, Peter's going to answer any questions, so please send them in.
Well, I'll answer some of them. So Lance has got a couple of questions here. Hi, Lance. First question, why is the bar black? That's when we were looking, I think, at this bar here. It's because it's a close level. So the close of that bar is the same as the close of the previous bar. So the computer colours it black. And then Lance goes on, why haven't I got any black bars? Well, it may be how it's set up. It may be how it's set up. So if you've got any queries with that, contact support@tradeguider.com, and they should be able to sort that if that's a query. And another question from Lance. I'm looking at my eSignal charting package right now, and if I switch over to the Trade Guide, the volume is different, all but the last price bar. Why is this? I can't really tell you a full description of why, but the different data provider may produce different results slightly. So Tom will actually probably address that. He's already touched on it actually, but let's just hear it again.
Well, you do see discrepancies in volume from different data providers. It may be from the time you started your time frames, perhaps. This is 15 minutes. But we get away with most of that, because even if the volume is slightly different, because we use relative volume. And that means it's relative. Today's volume, or that bar, is relative to the previous 13 bars. So we get away with, there's a lot of skullduggery within the volume world, should we say. Even commodities, apparently you can't get the volume till next day, and all this is absolutely nonsense on today with computers. Absolute. So there must be a reason why they're doing that, and the reason is, of course, the professionals can read volume, and they want to try to confuse or hoodwink as many traders as possible in there. It's like trading currencies. People say, oh, you can't trade currencies, there's no volume. But we can, because we use tick volume. And but imagine if you are a bank in Singapore, say. You don't want a bank in America to know what you're doing. They know you're trading, but they don't know the quantity, and therefore they hold back the volume. They don't give you any volume or the amount. And that's the reason why they do it. No other reason. But we get around that because we use activity volume, which is very, very good. And you can see that. I believe Gavin's doing something on currencies soon, I believe. Excuse me here. But that's with the volume. But various... I mean, if you, say, go to a larger time frame, you'll probably find the volume is fairly more like mine.
Okay, thank you, Tom. Another question is coming from Jerry. Tom, would you go long after a positive test of a rising market? However, in this example, price is at the daily highs Could this be dangerous, buying at the highs despite a test of a rising market?
Well, you have to be a bit cagey when you get what looks like a test at the top of these markets. But if you just wait to the next bar, if the next bar isn't up, then it's what we call a fail test. And I think we saw an example of that last week, which I hope I'm going to mention in a minute. But that was my mistake. I overlooked it, and I called it a test. Well, it was a test, but it wasn't a test, and I'll explain that in a moment. But you do have to be a bit cagey with these tests, especially if you've got weakness behind you. If you've got any up bar on very high volume, markets do not like up bars on very high volume because that's indicating the supply present. Professional money, they have to unload into the market as it moves up. If you can visualize that. If you've got 6,000 contracts you want to unload, you can't just dump them on the market because the various market makers and that will see you doing it and they'll reverse the price on you. So you have to unload in a rising market. And of course, if you're a professional, you get skilled at that sort of technique. But that's why they have to sell on up bars and buy as the market's falling.
Thanks, Tom. Question here from Priyesh. I hope I pronounced that correctly. The volume after London close drops away. Does that mean that VSA principles are less likely to hold? Tom's taking his jumper off. It's going to be hot. Did you get that question?
Right. Okay, Peter, just say that again.
Yeah, so after London closes.
After London closes.
Volume drops off.
Yes.
Does that mean that the VSA principles are less likely to hold?
Well, you might think that. But see, professional money, they never sleep really. I mean, if volume falls off and it goes up on no demand, you can almost be reassured that it's because professional money are not interested in higher prices. But you need to, I mean, we've seen that, I think last week there or the week before there was a half day in America. And they said, oh, well, that's because it was half day. But it still worked. It's best to go by the chart. And VSA gets away with it a lot because everything's relative, including the price spread. So it's looking at the previous 13 bars and saying, right, what's my position compared to the previous 13 bars? Only computers can really do that. Human beings are not really designed for analyzing continuous long strings of data, but computers love it. And that's why I was interested in the first place when IBM announced they were coming out with this desktop computer. And I thought, right, I wonder, because I had no idea. I'm not a programmer. I never touched a computer. But I thought, well, the main thing is a computer has no emotions. It doesn't think. It's not listening to the news. It's not being influenced by your wife looking over your shoulder. Nothing. All due respect to your wives, of course. Apparently, you have to be careful what I say with a mixed audience. So, I mean, women basically you get a good woman trader and they're better than the men. And I'm not just saying that because the woman likes to be safe, where men are often gung-ho and they want to pick the spear up and go out, having a go at the local dinosaur, where the woman wouldn't dream of that. She stays at home looking after the fire and the children. And they tend to do that while they're trading as well. And I see that quite a lot. Quite a lot. Now, please send any questions in now. Is there any more up there, Pete?
Yeah, a couple of things I can...
Hang on.
Yeah, so this is for Lance really. So you've got a couple of other queries here to do with volume and such like. It probably is worth getting in touch with AJ at Trade Guider just to get a clarity on exactly what's going on. I think he can take over your screen if you let him even, so he can see what's actually happening on your screen. So I wouldn't like to just guess what's occurring there. Contact support at tradeguider.com or give them a ring. I think their phone number's on the website, tradeguider.com, or some kind of ticket system for help. And then Peter, you're saying something about there's a problem with eSignal daily data for the add-ons on TradeGuider. Gavin Holmes is on the seminar, a seminar later today. If you want to hang around for, I don't know, is it 7 o'clock maybe, 1 o'clock Central Time, ask him that question if you've got a query over that. I don't know anything about the add-ons, to be honest. I don't use them. Now, where are we? Got Fiona. Fiona's saying trading is the best thing for housewives. Absolutely. Well, actually, question mark. Rita says absolutely. Yeah, okay. No, trading is the best thing for housewives.
Oh, yeah. Yeah, definitely.
Yeah, Lance doesn't fully agree with that. He says that he's the best thing for a housewife, but I'm not sure what he means by that. So Darshak is saying, if the professionals are unloading on up bars, how does the price move up on the up bars if the professionals are the only ones who can move the price up that much?
Well, no, it's marked up deliberately by the floor traders and pit traders, whoever, and those in the cash market. They mark it up deliberately so they can unload. It's a way of human nature for people to sit on the sidelines. You may see a signal appear and you say, oh yeah, I'll just wait. And then they have these, what Gavin calls a gotcha bar, which is a widespread up, close on the high, and that's done deliberately because they don't want you in on the trade. But if the market keeps going up, you eventually get fed up of watching this and you may go in, and especially if the news is good or they come out with something. But you're dealing with human nature, and don't forget, like an auctioneer in a public auction that's selling antiques or whatever, they always mark the price up to start with. If something's worth $500, they say, right, $800, and they look at the audience, and of course, if there's loads of professionals in there, they're not going to bid for something that's worth $500 at $800, that's for sure. But it's marked up deliberately because it's the auctioneer's job to squeeze as much as he can out of that sale, and that they always do that. I know that because they have all these auctions on TV in England here, and I watch them just for curiosity here. They mark it up and then try to goad people to bid up, and they eventually, usually, not always, they fall back to the price that will bring in people. But the market's the same. The stocks can be marked up. I mean, I know even in the commodity markets in London, dealers will mark up a price deliberately high so it shows up on the screen to they've no intention of selling it to you at that price or allowing you to buy it or whatever, but they mark it up deliberately for publicity, and you never know, somebody might take it. I know they do that. And then, but if you try to do a trade at that price, they say, I'm sorry, that's gone. And they won't be able to trade. But is there any other questions, Peter?
Yeah. Yeah, so on the subject of manipulation, if you like, Priyesh says, but in FX or Forex, it would be difficult for artificial markups. Is that not so?
Well, you say that, but if you look at the currencies, I mean, you'll see that the principles of supply and demand work very, very strong in currencies. You'll see, say, the pound or a currency falling, right? It'll fall until such a point has been reached where the market is vulnerable to professional money either unloading their holdings that they bought, they sold, and buying back into the market. And you can see the volume coming in. If you look at Gavin's seminars on this, you'll see it clearly. And see, professionals tend to specialize, and like you never get a wheat trader trading corn, for example. And the same thing really with the mini S&P that we're looking at here. This is a daily chart we got up at the moment. They tend to specialize, and if you keep jumping around, you probably will miss a lot. You tend to specialize in these subjects, and you'll see the currencies work very well, and you see the surging of it. See, don't forget, it's not volume, it's activity. If that currency is dropping, right, 1, 2, 3, you see the bars are red. They don't want to let anybody out, so they keep marking it down, down and down, and suddenly you see a huge surge in volume on the down bar. Then you know that the professional money has intervened in that move, and that's what we're looking for. And you need to specialize, because some of them test, some of them don't, some of them more or less go sideways a few bars and up. So you get, it's just like you know the personality of your children or something. It's a personality of the chart that you need to be very, very familiar with. But if you jump around trying to be an expert in everything, you'll probably miss a lot. Now, to be quite honest, last week I missed quite a bit, I thought. Now, this is S&P 500.
This is the future.
The future.
Do you want the cash one?
Oh, this is the future, isn't it? Okay, now, okay. So, last Monday, we looked at that bar there, look. And there's even a signal on it. Right, which is fair enough. It is. It looks like a test. Without any question, it looks like a test. Okay, and the volume is, it is low, isn't it?
Yeah.
Now, the thing is that I predicted you were going to get higher prices, right? But the next bar is down, so immediately you're warned that something is wrong in the holding camp, right? You should go up. However, if you look at that volume, it is low, right? And you're not too far down. You need, the market needs to fall, but, okay, but can you put the cash market up, Peter?
Yeah.
Now, I'm going to ask Peter to put the cash market up. And that trend line, I think, is drawn automatically. Now, this is the cash market. Remember that the future is a derivative of the cash market, right? Without this cash market, nothing's going to happen. And if you look at the same day, Monday, look, right, I believe, if I look down at the volume, look, it is not low, really. We need that computer to color that pink. Something like this, look. So I wasn't looking at this chart, so it just shows you. You need to check your chart. Sorry, it's updating live. And if I'd have seen that high volume, I would have said, right, it's not, it looks like a bit of the spread and everything looks fine. But it's too much volume there. And next bar, look how crafty they are. They marked it up here, right? That's done deliberately, kept stops, misleads many people as possible. So a lot of people would have misread that bar, including myself, to be quite honest. So they mark it up, look. and then suddenly turn around and close the low, and that's really a fail. That is not really a failed test, which is a sign of weakness, and that's why you got these lower prices. Okay, now what's interesting is this chart is only up to date to yesterday, and lo and behold, click on that, Pete. Peter has to do it because I can't see very well. That's it.
Strength coming in.
Yeah. So that's what's so good about a computer. Look, it tells you there that strength is coming in with that yellow box or green box. Now what will happen now, because today is up quite strongly, right? And the reason why it's gone up, look, there's a surge in volume. Not a lot, but it's there, look. And on that activity, on that volume, it's closed in the middle. So it's definitely strength on that bar. That was yesterday, Thursday. And that's why today it shot up. And then you'll see a green arrow on this because the strength has been confirmed. And that's why it went up today. Does that make sense?
Thanks, Tom. So more questions here. So back onto the subjects of marking up or down prices. Darshak is saying the following: but if the price is marked up on high volume, then presumably the activity is high on that bar, but for the price to go up, does there not have to be more buying than selling? If there is more selling, how can the price possibly go up? Tom?
Well, you may say, right, at the auctioneer, in a public auction, how can he call $800 when everybody knows it's only worth $5? Does that make sense? They mark it up. They can mark the prices up and down. They may be a lot of selling, but they're trying to attract buyers into the market. Think about it. They have to unload, and they can hold the price up. Don't forget, they're all not all. I'm trying to think of a word. Not all that honest.
Not all angels.
Not all angels. That's better. They're not all angels, and they do this deliberately. They have to. They mark it up on the news. And the thing is that, yes, there may be some buying coming in from the public and banks and people like that. They don't really know what's going on, and many fund managers don't, right? But as the market is gummed up on the news and on buying from outside, professionals unload into their buying. You come along and say, oh, I'll buy. They say, sure, they are. And they immediately sell to you. That creates a high volume. And you see it all the time here. You don't have to ask questions. You can see it's high volume on up bars that stop these moves. Well, I can't find one now, but the experienced VSA users will know this, that it is whatever you see, it's no good being too clever and trying to ask too many questions. Believe the chart, because you'll never be told the truth anyway. Even if you ring up the exchange or get hold of a trader, they won't tell you the truth. Why should they? That's if you can get them to talk to you. They sell on up bars. And if you see an up bar after you see an up move behind you, the market's vulnerable to one or more professional groups selling into the buying of people being sucked in. And that's how they unload their holdings. Been going on for hundreds of years, that. And it will continue for hundreds of years. And the other side of the coin, they have to buy on down bars.
Thanks, Tom. Now, a question from Abraham. How do you interpret opposing signals on different time frames? For example, no demand on a 1 hour chart and on a 30-minute chart, sorry, I'll say that again, no demand on a 1 hour.
I think is that up thrust?
Ah, okay, yeah, so that's it. Here we go. No demand on a 1 hour up thrust.
No demand on 1 hour, up thrust on 30 minutes.
Oh, I see. Rita's interpreting the question better than I can. I'll hand you over to Rita.
I assume that UT stands for up thrust, so no demand on a 1 hour, yes, up thrust on a 30-minute, and a test on a 15-minute. So, Tom, how do you interpret these opposing signals on different time frames?
Well, I've never seen that happen, and I'd like to see the evidence in front of me on the chart, to be quite honest. But if there's a test, you might get a test on a 1 minute chart, or 2 minute perhaps, and that's all you're going to get. You're going to get 1 or 2 minute move. Right, let's look at it.
What chart are you talking about? I've seen
Which chart?
What chart are you looking at?
And he says an up thrust on the 30. Yeah, you're on the right chart.
Up thrust.
Okay, so yeah.
Well, yeah, and then on a 15.
Is that up to date? Yeah.
The test.
Yeah.
Oh, I see what you mean.
Yeah.
Yeah, but there's only what's this time frame?
15.
Yeah.
And the up thrust's more clear along the time frame.
On the 30-minute, there's a little bit more clear, and it's no demand. Well, is it? Yeah, no demand. Let's just make sure the data's correct.
Well, the thing is that you're looking at this chart here, but that sign of weakness is genuine. And sometimes say you see you look at the 5 minute chart and you see a huge move, you say, oh my God, look at that move. And you look at the daily chart and it doesn't seem to have moved at all. So don't forget, you're looking at different time frames here. But this chart here, I would say, is weakness, which I've said to you previously was weakness, and it's slowly rounding over. I would call that weakness. And if you look at that smaller time frame with a potential test there, yes, it may go up for a few minutes, but you're not going to make any money out of it, I can assure you.
It says, where do you initiate a short?
Right. Well, there you are. You see, I mean, we've spoken about this. We have it in books. We have it on discs. The short sign is that when you see a sign of weakness appear, like an up thrust, right, you can short those because they usually appear after you've seen weakness appearing anyway. And we see the weakness here. Look, we've got several red arrows. Look, professional money are fully aware of that. They've seen all that. They know that's there. They're not blind. They can see that. So what they do, they mark it up, look. And they marked it up, look. And we know they marked it up because there's no demand there, look. They mark it up like the auctioneer marking items up. Then the final little up thrust, enough to bring a signal up, look, and the volume is incredibly low. We know that's an up thrust. Now, if you see no demand here, I would say that's when I would short. Rita shorts these up thrusts. I would short an up thrust because it's an up thrust. You know it's an up thrust. Look at the volume and look at this weakness back here. They're fully aware of all this. Here. That hasn't gone away. That is there, and they know it's there. Does that make sense?
Yeah, Abraham, so in other words, which carries more weight? It's the bigger time frames, So you might get little opposing moves in the smaller time frames, but the bigger ones carry more fuel or weight, as you say. Okay. Peter? So would you short now? I wouldn't.
So Abraham goes on to say, would you short now? And Rita says, I wouldn't.
Because it's very slow at the moment.
Is that 5 minutes?
Yeah, that's 5 minutes. Yeah, so Rita's saying she personally wouldn't short just at the moment because the market's kind of gone to sleep.
In half an hour, things will start.
Yeah, things will start cranking up again in about half hour or so. That's just Rita's, way.
So, 5 minute chart, look.
Does that need?
Oh, look at it. Is that right?
I'll just go to do this just to be sure. Because it looks a bit odd, doesn't it?
Bear with us, folks. No, that's correct.
Yeah. Yeah.
Yeah, we just turned the sleep function off the computer before we started the seminar, so some of the charts needed updating because when the machine went to sleep, of course, the data gets cut off. That's why we were just checking.
Well, that's a sign of weakness there.
So Tom's saying that's a sign of weakness. That's
But you do have a bit of a test there. Don't forget, we look at the 5 minutes. But that's
So
if that test was genuine, then you wouldn't get all these sideways.
Let me pass you the mic, Tom.
This is a 5 minute chart, right? This is definitely a sign of weakness back here, look. Right there, look. That's an up thrust in anybody's language. Right, that's done in a weak market. They do that to catch stops, mislead as many traders as possible. However, it's weakness, but you've got a little kind of test or come shake out here, look.
Basic test.
Basic test. And it's that bar there that allowed the market to go sideways. Look, don't forget it's Friday. All these black bars just mean that it's level. There's something fishy going on here. But it's Friday. And they will may want to close on a high to mislead as many people as possible, including all the newspapers and television programs. So over the weekend, you will be reading this. If you don't understand volume and VSA, you'll be reading all that. And you've got to realize that you know more than they do. They don't know any of this. I know they don't. And, okay, so that's why it's gone sideways. I certainly wouldn't want to, I'd rather be short than long, that's for sure. But I would be cagey because this does look like a test. It's gone sideways, which again is negative. If that is clearly a test and the next bar's down, there's no selling pressure. If that was completely genuine, that market would have shot up. Professional money, they do not go to sleep. If they see an opportunity to make money, they're going to dive in and take it. The fact is, you've got a failed test there. It's just gone sideways. Look, sorry, it's updating. As far as I'm concerned, that market's weak. I wouldn't do anything at the moment because I would like to see a principle appear. There's only about 3 principles at the top and 3 at the bottom. And Rita looks at 1, the up thrust. We all look at that. And we have to see that clearly before we make any. It's so easy to lose money in this market. 90% of traders lose money trying to scalp these markets. And only 10% make money. And the whole object of us talking to you is try to move you over to the 10% that make money.
Yes, and as Eleni's just said, if the markets are unclear, step away temporarily. So that's what Tom says that's true. That's what I do. And I haven't always done that. I've got caught out several times. So I've learned by painful experience that if you can't really see what's going on, then walk away, or as Tom says, turn the page to something else, because you'll be gambling. Wait for a principle. So what other questions do we have here? Oh yeah, back to that daily cash. There's a question here from Solomon. Could you explain the red bar on the 21st and the blue bar on the 29th? The volume looks about the same. 21st and 29th. It's not quite the same actually. It's higher on the 29th. So I'm not really sure what you're getting at. So I'll read the question to Tom. He might understand what you're getting at. Could you explain the red bar on the 21st and the blue bar on the 29th? The volume looks the same. Can you see anything there, Tom?
Well, in one case, the aircraft is landing, and the other one, the aircraft taking off. That's the difference. That is the difference. And that's why we colour the bars red, to let you know that the market's falling or fallen on that day. And we colour them blue, right, to remind you and let you know that market's going up. But there's a vast difference there. One in case the plane's landing, the other one's taking off. It's the exact opposite. Now, so the volume's got no relative at all. Don't forget that we're looking at, it's called volume spread analysis. So we also look at the spread. And we've got signs of strength behind us. We've got signal, look.
This is Solomon who's asking.
What?
It's Solomon who's asking the question. So maybe you need to explain to him.
Go on then.
Well, that. Yeah. So as it's Solomon who's very new to VSA, I thought perhaps Tom, the reason for this big blue up bar here is probably a reaction to this, and this is a setup here, which Tom could explain to you. One of the setups at the bottom of the chart.
Well, the setup, we call it Rita's on about, it's this section at the bottom, isn't it? Look. Now, okay. Now, what? Is there high volume coming?
On that one there is, yeah.
There's a bit increase in volume there. Professional money would have seen that, right? So they still mark it down, look, and now the selling pressure has been removed from the market, seen on that low volume. So the professional money, the ones that shift these markets, are not interested in lower prices because they've marked it down, and lo and behold, there's the low volume. Okay. So we need confirmation. So market moves sideways, and there's the test, look. And that's produced a signal, look. So computers automatically seen that. Test. And what it's doing, it's testing this area here. Because the markets move on supply and demand. Here, there must be supply somewhere, right? And no selling pressure there, so they test it. They want to know. The biggest danger to professional money is that if they orchestrate an up move, which costs them money, there's people lying in the sidelines waiting to dump holdings onto them, and they can't afford that, so they have a test. And they won't mark that up until they get a positive test, and there's one. They call that a setup, and that's why you get this widespread up. Does that make sense?
Right, a question from Mitchell. How would we recognise that as a test if its volume is the highest in the area?
What? Say that again.
How would we recognise that as a test if its volume is the highest in the area?
Where? What is he talking about?
That test bar.
We're talking about this one here.
This one?
Yeah.
Is it higher in the area?
Well, it's higher than the last couple. 3.
Right, let me have a look at that. That's it there, isn't it?
Yeah.
Okay. How would you recognize it as a test? The reason is, how would you recognize that? First of all, the market's fallen, look. Now, when the markets fall, it makes the market vulnerable to one or more groups deciding they can move in and make money, right? Now, we don't ask too many questions, right? But it stopped dead in its tracks there, look, and that's because there's no selling pressure. Okay, market moves sideways, and that is a test in anybody's language. Ignore the volume from now because they're buying. A little bit increase in volume means that they're buying. And how do they buy? It's been marked down, look, back into this area. It's closed on the high, right? And there's a signal produced, and that's why it's produced it. And that's why you get higher prices. So what I'm saying to you is the logic that we must have fed into this years ago must be correct. Otherwise, the signals would look silly. And but that little bit of buying there, that's why it's gone up. That whenever you see a bar plummet down like that, especially back to a level here where there was support, it closes on the high, right, and it's produced a signal anyway. Look, I'm sure it says a test.
Test, right.
Test, right. If you don't know what test is, just ask us. Okay, that's what we're here for. We're here to teach you to read these charts. Okay. Now it's come off up here because of this weakness here, look. Here. No demand, look. Right. So, I mean, you can't really argue with that, is it? Look, the signal's there.
No demand.
Right? That comes up automatically, telling you. Now, if you're too clever, right, and start asking too many questions, you may ask questions that you'll never be told the truth anyway. That is no demand. And that's why the market's fallen off, look. I'm sorry, it's as simple as that.
So Mitchell's asking, so the close position is more important than the volume. Tom?
No, we never say that. The spread, we're looking at the volume or activity.
I'll rephrase that question, Tom.
Rephrase it, Peter says.
Because he's added, so the close position is more important than the volume on the test.
Well, volume is normally important. It has to be low to be a successful test. And just check the cash market, the daily chart as well, and the Dow and the NASDAQ, because they all follow each other. The close, you're right, is not all that important. But when they're trying to do a bit of skullduggery, they often close on the high to give you the impression the market's going up. But it's volume, range, or spread analysis. Look at the volume, and on that volume or on that activity, what did the price do? If it's an up bar, a narrow spread, and you've got a move in the background up, then you can almost bet your bottom dollar that that's no demand. And if it comes up with an automatic signal, that confirms it.
So final question from Alan. How do you relate the May strength in the background to the weakness in the more recent chart action? So I've put up more bars. We can see May is around here. There's a shakeout there. So how does all this that's going on now relate to the strength in the background?
I mean, in the background, you can see that was a shakeout in anybody's language here. And you've got some strength coming in here, right? But then that's what they call, Wyckoff called that a springboard, actually, where they ram it down as far as possible, probably on some bad news, rapid recovery, That's a springboard, and on that it's gone up, look, and that's why it's gone up. Simple as that. But zigzagging up and down. But look, we got signal. It's unusual if VSA doesn't capture most, well, it does all of them if you can get the right time frames, tops and bottoms.
Okay, thanks, Tom. Hope that clears that one. So that's it, folks, from Tom for this week. Thanks for all coming along. Some great questions this week, and I hope we've answered at least most of them. Any other questions you have that you feel are burning, you can come on to the next seminar, either with Tom or somebody else. Gavin's on at 7 o'clock tonight to 1 p.m. Chicago time. And who's that for? I'll hand you over to Gavin. Hang on.
Yeah, hi everyone. Anyone that trades futures, 1 o'clock today, infinityfutures.com. You can sign up from there. Detective Holmes investigates the futures industry. I had an account with PFG Best, who recently, last Monday in fact, liquidated. So I've got a lot of questions that I want answering. And today at 1 o'clock, I interviewed the Vice President of Infinity Futures and Transact, a guy called Jim Cagnina, who's coming in to tell us a little bit about the implications for the futures industry, about what happened to PFG and MF Global, and what we should look for to ensure that our money is safe when we're choosing a brokerage firm, especially a futures brokerage firm, in light of what's just happened. Should be a very interesting event. There's several thousand sign-ups, so I think we're going to have a lot of people there. So you can register for that at www. Do you want to type this in, Peter? It's www.infinityfutures.com. That's www.infinityfutures.com. Click on their events section and you'll find the sign up to today's free event. It starts in 20 minutes and it should be quite interesting because I'm going back to my police days. I'm going to be interviewing. Should be quite an interesting thing to see. So I'll see you all there, and then at 9:30 tonight UK time, because I'm here with Tom, 3:30 Chicago, the closing bell. Going to be looking at what I think is going to happen with gold. We're very close to the breakthrough in gold, and I think next week we could see it, and some very interesting developments in the news about gold and silver. So see you all at 3:30 or 1 o'clock.
Okay, folks. So that's it. This seminar will be archived, we hope, in the next few hours or so, with any luck. And Tom's doing his newsletter, I think, at the weekend. Tomorrow or Sunday. That'll be posted on the VSA Club. Always very interesting. So yeah, have a good weekend, and we'll see you next week at the same time.